Welcome to Beyond Bitcoin, a podcast about all things digital assets, the global communities they are creating, the generations that are using and investing in them, and the challenges faced by the nations that are seeking to regulate them. The content of this program is not to be taken as investment advice. My name is Derek Graham. I'm the CEO of Portal Asset Management, and my co-host is Nitin Gower, CTO of Portal. Good morning, good afternoon, good evening, wherever you are in the world, and welcome along to Beyond Bitcoin. My name is Derek Graham. I'm the CEO of Portal Asset Management, and along with me today is my friend and colleague, Nitin Gower. Hello, Nitin.
Hey, Derek. Glad to be here. I believe you're back, and I'm back on the road. So it's back to the same equation of you staying at home and me being on the road again.
That's right. And for viewers that expect this regularly on a Thursday morning, we're very sorry it's a day late because of travel challenges. I've been to Zurich and Geneva and London, which has been most fascinating because, of course, it's the world of financial management and fund management. And I'm back now in the land of Oz. And you're back on the road in Boston, I think.
I'm in Boston, attending to some of the work that I had here as well.
So look, today, because I've been in this traditional world of fund management, I wanted to sort of raise this, what's happening in the market at the moment and how dissimilar in many ways the markets are between the world of cryptocurrencies and crypto exchanges and the traditional exchanges. So some of this is going to be just factual statements, others are going to be observations. But, one interesting thing is that the crypto world operates 24/7 all around the year, and it operates in every country non-stop. Whereas the traditional markets, such as the market in Australia, starts at a very gentlemanly hour of 10 o'clock on the eastern seaboard and finishes at 4 o'clock in the afternoon. So it's actually doing 6 hours a day trading. So in their case, they've got 18 hours a day to rest, have dinner, talk to their friends, you know what I mean? And decouple from what's happening in the marketplace. I'm not sure. This is really important because human beings are human beings. And if you're operating them 24/7, there's no time for them to sort of settle down and rethink what's happening. So firstly, this market operates 24/7 and it's intense. Secondly, traditional markets have a very large inflow of money every single week, every single month. And that's from the big superannuation companies and the large institutions that are forced to buy. They're forced buyers. They have no right not to buy. So they must buy into a marketplace no matter what. No such buyer exists in the crypto market. So billions of dollars aren't forcibly invested into it every single week, every single month. The other thing is that, interesting enough with the downturn at the moment, I was listening to the Australian Broadcasting Commission, and one after another, the big superannuation companies are coming on to give advice to superannuation holders. Well, what they're telling them is, hold on, the market's gone down. The market goes down before, it'll rise again, everything's fine. This is the typical nature of markets. Well, of course, they're correct. But which large institution comes on and says that about the crypto marketplace, Nitin? None. In fact, not only none, but they're the opposite, because a lot of them will come on because they're threatened by the marketplace, and they'll turn around and essentially say, I told you so. So you've got a market that also doesn't have any governmental intervention. And of course, many purists will say, well, that's a wonderful thing. But, if NASDAQ dropped 25% in a day, there'd be a trading halt, wouldn't there? And that would mean that people would have to go away and think about it and wonder whether they're getting too overheated about this, et cetera, et cetera. No trading halts exist in this space. So by the time you've got 24/7, no trading halts, no interventions, and the industry not talking it up, you can see why this market is so volatile in just these natural reactions of how human beings work. But there's other reasons it's volatile too. And I think that's what you wanted to talk about today, which really, I think it's about infrastructure and guidelines and the things that this market probably needs to become mature from. So yeah, interested to hear your thoughts on that.
Yeah. No, actually, I usually, when I write and I talk about Derek, I stick to my roots. I stick to technology. I looked into business models, looked into what the financial industry and what the other adjacent industry should be doing. But this last weekend, I spent some time I've been researching this for quite some time, especially since the Terra fiasco happened, and now we
Yes.
have three, and now you have the ripple effect. I wouldn't call it,
Yes.
I wouldn't use the term contagion, but I would say it's a ripple effect because now you have dependency on these sort of liquidity that is coming from, which again we've discussed this many times. But
So
I
that's
really want to
coming
focus
that's coming from
the
Terra Luna, Celsius, and now Three Arrows Exchange.
Three Arrow Exchange, and I think some of the elements again stems from, it's undeniable that global macro has a role to play in it, but it's also something that I think that our industry, the crypto industry, lacks the market structure, lacks the discipline, lacks the data. And I'll
Yes.
spend some more time in talking about the 4 prescriptive approaches that I have sort of devised in terms of what the industry should be doing. But in generally, I think that the crypto industry needs what we call a crypto capital market structure and convincing innovation narrative, which means we have to do a reset on learning from failures and building upon successes. We've had success stories. We've built
Yes.
wealth out of this industry, and we've proven in many cases, whether you look at DeFi, look at NFTs, the art of the possible. And this has all been a huge experiment. And I think it's time that we reevaluate this from the existing failures and undo that mistake and build a market structure that can be globally trusted. And of course, there are some challenges, hence the term disruption. Blockchain and digital assets as technology frameworks is meant to disrupt existing industries. So, past few weeks have been interesting, Derek, which have sort of surfaced in what in the financial industry we call as MRA, or something called matters that require attention. So MRA in financial service industry describes a practice that deviates from sound governance, internal controls, risk management principles, and there's a mechanism in place to say you have to go and fix it. And that's essentially the cost structure of the financial service industry. And with growing number of naysayers that we have seen have been vocal due to the recent events, laden with mismanagement, ill-defined and misgoverned systems. Exactly what we have seen with Terra was, again, bad tokenomics, right? Bad governance mechanisms. You can't blame the technology for that. And in general, misrepresentation of the industry. I wanted to actually have a systemic view of the industry, and that led to this point where I want to dissect the failings and be prescriptive on learnings from that failure and build upon that successes, as I mentioned earlier. So I think few things which I think we should discuss here is, one is, in my opinion, drawing parallels to what would this be if this would happen in the existing financial market structure, which I think has lost significant value, except that the market is big. It's $407+ trillion compared to $3 trillion. So the bear market, as we call it, has a much significant impact on crypto than it has on traditional markets. But I think we should look into that. We should look into what is the current financial market structure that has shock absorbers, that had guardrails built into it,
yes,
to prevent something like this. I mean, yes, there's always a risk. There's risk in every single market. There's market risk, there's economic risk, there's governance risks. But how does the industry cope itself in managing those risks, which is a big part of this, of what we're doing. Second thing is, we should evaluate the current state of market unstructure. And I'm using the word unstructure in crypto, where the promise of Bitcoin started out with those guardrails. I mean, essentially the genesis of this industry. So we should look into what is that structure today. Have we simply created a digital analog? I know it's an oxymoronic term, digital analog, of the existing market structure, or are we have we lost that thesis and that promise that Bitcoin and subsequently blockchain promised? And then we should look into some of the prescriptive approaches that I think that we should rethink and learn from these mistakes, and instead of looking into failures, look into what can we do. So when we turn, when we turn the industry around, it's much more stable, it's much more resilient, and actually it has a lot of stability built into it in terms of efficiency of the market, which is the intent. So I'll pause at that. I think we should dissect this a little bit.
So Nitin, what's interesting now is that it's getting acknowledged as a fourth asset class. And that's quite historic, because it's,
I think it's a fifth asset class. Yeah.
It's, well, if you want to define cash and real estate, equities and bonds, then it's a fifth asset class.
That's right.
But certainly it's a new asset class. And it's the first new asset class since the 1600s. So it's pretty impressive that it is a new asset class. What comes with that is the sort of the desperation of traditional methodologies of doing things to be overlaid into this space. And it's where the challenge is going to be is to take the best and most relevant part of traditional finance and put it into this totally new methodology of reflecting assets and trading currencies and creating business models. And I think that's where we hear the term reg tech, regulation technology, on a regular basis. Never thought regulations would be defined as a technology, but reg tech is encouraged into it. So what are your picks and choices to really make a difference to this industry that you think we should bring across from traditional industry that will provide the right sort of guidelines to give investors comfort, and not just retail investors, which is very important for the mums and dads, but big institutional investors, which in many cases have retail investors in it?
Absolutely. So I think we should take a step back and look into understanding existing financial market structure, right? And when we use the term market structure, it means who are the players, what they do, how does the entire system work? So if you look at the modern financial market structure, it's essentially a chain of interconnected market participants, which aid in one, accumulating capital, which is when you take the deposits and people make investments, and you have investment managers and you have banks, and form investment resources, which is, when you form a fund which is attracting capital, and you sort of create the basic building blocks. And then you have the market participants that have a specific function, such as an asset custody. There are people who are third-party custodians, and I happen to work for one of them, in my day job. And looking into this from a perspective of the fact that you have a central bookkeeper, which is the central security depository, like DTCC, for example, and you have liquidity provisioning, people who provide liquidity to the market. You have clearing and settlement. And because either by function or by capital constraints or due to regulation, many of these entities are not vertically integrated, thus preventing collusion, which is the entire genesis of Bitcoin, essentially. Or take a unilateral investment decision, which means that not a single entity, which is a risk with many of the vertically integrated crypto firms, like, for example, Coinbase, they perform all these functions unilaterally, which means it's easy for them to be able to change books and for short term until things catches up with them. So it's hard for any of these because of lack of that vertical integration. And it prevents collusion and takes this, a path where you need to coordinate these different systems, which again is the problem that we say that each of these entities are taking a fee because they need to stay in business. So various products, while maybe governed by a different market and fundamentals of financial primitives, remain universal. There's a lender, there's a buyer, there's an interest. In terms of lending, there's a cost of lending that's called yield, and you provide a return on that investment. There's a whole process. And then someone has to post collateral. Somebody has to sort of ensure that you have enough liquidity to be able to pay for short term so that the clearing can happen within the governed stipulated time, which today is T+2, which is within 2 days. The settlement should happen in terms of actual payment of money. And many of these entities have to post collateral to be able to ensure that they're able to. So there's these shock absorbers that are built in the system, again, due to the past failures. The existing market structure exists, and it's still evolving, in my opinion, which means that SEC's recent ruling has talked about T+1, which means that you need to settle every security settlement, which means when you buy and sell, has to be settled in a day. Well, to do that, you're suddenly increasing the velocity of movement of money, and suddenly now people have to keep additional collateral because they have to make sure that they have enough shock absorbing capability. And I think that has a plus, that it alleviates risk. But the negative is that it's capital inefficient, which means the capital is simply locked and sitting there and it's not doing anything. So that is the existing market structure. And I think crypto aims to disrupt some of those things. And I'll take a pause here in a minute. And to me, I want to understand what are those things or those sort of components that can be done today, but at the same time, what is that capital market structure that we need to build, which not just mimics the shock absorbing and efficiency and stability of the existing system, but also be able to provide a much more refined, so the capital is more efficient. There's less fee structure and there's more transparency in the system, which is essentially why we got into this business. So I'll take a pause here, Derek, to see if that made sense.
So you see T+2 or T+1 as a safety mechanism and inefficiencies at the same time. So certainly from the world of a blockchain, a transaction that takes T+1 and goes onto a double entry bookkeeping system is sort of grossly inefficient in comparison to something that happens instantaneously, is laid down on an immutable blockchain, far better system. But of course, what comes with that is you're saying is there's an inability to rewind a transaction or an inability to negotiate a settlement or something. There's kind of strengths and weaknesses in that, are they not? Because if you do operate in a crypto world, you've either got your digital assets there, or you can't do the transaction full stop.
Agree. And if you look at, like, for example, let's look at the global financial crisis, right? 2008. And I think Bitcoin system was proposed as an experiment that was born out of the global financial crisis as a prescriptive approach to rethink a financial system. So what happens in that financial system today is, of course, you have all these shock absorbers, which means that you have banks and you have people who have to post collaterals, you have intermediaries who have to make sure all the things are in place. And if all fails, then you have the central government, that's the central banks and the governments which step in to provide liquidity. Well, there's no such mechanism in the crypto world. There is no big brother. There's no entity that provides liquidity. It still relies upon the participative economics that we talked about earlier in this. And I think few things that Bitcoin brought to attention. One, this injection and intervention from these world entities, whether it's governments or central banks, was seen as something which was at least at the time was causing problem as opposed to fixing it, right?
Yes.
That you're not letting capitalism work. You're sort of, every time that something goes wrong, you step in and you provide more liquidity. And the question then became that, can we reimagine an order to organize a world community to reduce dependency on a few large economies with influential hegemonies, which is again the USD and the euro and so on and so forth. That was the imagination that Bitcoin introduced. And so I think there are two things. Every system, there's no such thing as a perfect system. So when I talk about envisioning a market structure with what we have learned from Terra, what we have learned from Celsius, what we learned, that there's risk in everything. And I think that one, the risk should be understood. And for us to understand that risk, we need data. And we'll talk about that in a few minutes. But in general, I think that as we build the structure, our design principles for the structure should be, of course, efficiency. Otherwise, what's the point in doing all of this stuff and expending talent, time, capital in building these new systems? Second thing is, looking into resiliency of the system. That system should be able to absorb something like Celsius and Terra with a blimp. That it shouldn't be a huge taxation. It shouldn't tax the system to the point it has done today. In addition to what is happening, with crypto, with global macro and crypto macro, as we've discussed here.
Can I just stop you there for 1 second? And that is that how much of the contagion of, preemptively Celsius, we don't know whether that's going to be a bad outcome or not, but it's not looking good. But Terra Luna, which is clearly defined, and 3 Arrows, which is a self-managed, a major fund owned by a number of people, not a large number. But how much of that is direct contagion? In other words, that has impacted a value to the marketplace, which is going to take out value, or how much of it is perception, just fear? All of a sudden, FUD is occurring because Celsius comes in. Because Celsius is on hold at the moment. There's no major change to what's happening with Celsius, but the panic has hit.
Correct. Actually, there is change. You can't withdraw your funds. That's a big change.
Yeah, that is a change.
So that is a big change, right? I think if you, I did some research this morning while I was going for my exercise in terms of looking into what's happening with the industry in general, right? So I think 68 to 70% value has been wiped of the entire industry, and that's means that that all the value that was created over time has been lost. And I think many of so in Bitcoin as a measure, we look into Bitcoin's day loss, which means how long has Bitcoin been in a wallet, is one of the metrics that has been looked into in terms of the hodlers, the whales, and the confidence in that. And I think some of that actually, and the primary reason for that is that many of the institutional investors and many of the sort of the whales, as they call them, there's a need for liquidity for all of these guys because they've made commitments, they've made investments, they've made capital commitments based on that wealth effect they've had because of the higher valuation that we've seen the past few months. And due to that, one thing I think stablecoin is the primary bridge between the traditional finance and decentralized finance and crypto finance. And while that has dried up because of, again, global macro, tightening of liquidity, we've seen this massive vacuum of liquidity. And oftentimes people have looked into saying, how bad is this quote unquote contagion? Though I would still not use the term, because I think we still have a long way to go and understand the ramification in the industry. But at the same time, the question is, for many of these institutional investors and institutions who have bet their farm on it, they would like to, one, meet the short-term requirements, so liquidity requirements for their funds, and at the same time, they want to not have any more bleeding, which can cause the further sort of loss of confidence from the investors. So there's a little bit of combination of both that is leading to this liquidation, and this liquidation is equivalent to, I would say, a bank run. And I think some of that is just a fear and uncertainty and doubt, the FUD factor that, as you mentioned, and some of it I think is just a normal business needs. People do need capital to deploy, and people need capital to do their payroll and do working capital. All that is still a need. I don't think crypto negates that need per se, if that makes sense.
Makes good sense. So Nitin, what is it that we should take from traditional? What sort of guidelines are you suggesting we should put into the industry?
Yeah, and I spent some time. I don't think we need to have a complicated structure per se. I think I have 4 prescriptive measures, and I've put a lot of time and thought into it, Derek. Since you all were traveling Switzerland and having great time in Europe, I had to do some work on your behalf. And so I think we should rethink stablecoins. And I say that because I think, and we've had this discussion, I can't get enough about stablecoins. We've dissected them, we've looked into the economic factors. And I think that revisiting stablecoin to me is an important part, because one, that we should look into eventually figuring out a mechanism that for the industry to self-sustain, we need to have our own fungible asset. So right now, we're providing banking on-ramp, off-ramp, and liquidity moves from traditional finance, which is the USD and Euro, into crypto finance and digital, decentralized finance. And I think that also inherits the challenges of global macro. So anytime there's an event happening, like we've seen recently with quantitative tightening, for example, which is a tightening event, liquidity moves out as easily as it came in. And that actually has a dependency on it. So rethinking the stablecoin and looking into, can we then rely upon the layer 1, which are sort of the backbone of the entire industry, like Bitcoin and Ether, as truly fungible and liquid assets? Can we rely upon these assets and build bridges, which allows us to be able to have complete dependency for things like payments and things like unit of account, things like medium of exchange, all the things that we look for in money. And I think we should rethink stablecoins, both in terms of reducing dependency, but also as a vehicle, which is the second prescriptive mechanism, is decoupling. Decoupling is an interesting part where it's essential, in my opinion, for crypto industry to not only provide the diversity in investment landscape, but also a model for efficient and resilient asset class, transaction systems, and an effective market structure. As we have seen the stablecoin, which inherits this element, as I mentioned a few minutes back, global macro, it increases also correlation, which is what we have seen in this particular event. So decoupling crypto and rethinking stablecoin, to me, go hand in hand in terms of how we look into it. And on playing on the words, I think coupling those two to decouple us, the crypto industry from the traditional finance, I think it'll be good both in terms of providing a parallel standalone structure, but also providing the resiliency and what it needs to be able to have it, stand on its own merits. Second thing I think is really, really important part, which I think you touched upon at the beginning of this, is robust crypto market data. Crypto never sleeps. It's 24/7. So you find a lot of information asymmetry, that we have a lot of data, but we don't have a lot of insights. And what that means is that there's adequate data, but there is fragments of insight that's available, and only for the few who have the motivation, who have the resources, who have the compute power and the talent to be able to digest this information, are able to take advantage of these things, which I think is unfair. And I will touch upon efficient market hypothesis, which again states, we've discussed this on this show as well, and if all the market participants have all the information all times, then the market reaches a state of equilibrium of demand and supply, because suddenly now you know what something is worth, what's the value and what's the price, and price value equilibrium suggests that if everybody's acting on the same information. Right now, crypto industry is going through a massive amount of information that I don't think is consumed by all the participants alike. So that is a third prescriptive approach. And the fourth thing I would suggest, which is such an essential part in what existing market structure has, is starting with crypto self-regulatory organization, or SROs, where the SRO by dominant industry players like major layer one protocols like Ethereum, and Solana, and Cardano, Bitcoin Foundation, which actually has the power to create industry standards, professional conduct guidelines, and regulation to steer the industry in the right direction. And I think that's something like what many of the like FINMA and FISMA, these are also SROs. The enforcement and violation can come through a broader education and appeal to the community that supports a project to say, hey, community, don't vote on this project because it's violating these governance principles. So instead of going after purely enforcement actions, I think they have an avenue to influence the community that's the heart and soul of our industry, to be able to influence their vote in a certain proposal that may be either counter to the transparency and governance mechanism. So I think these four elements to me would be good starting point to undo some of the damage that projects like Terra and Celsius have done to our industry. And again, there's no crack at these. These are all experiments in my opinion. Some of them have good intentions, but things didn't go well. But I think we should learn from that. I'll take a pause at that, Derek, to see if that makes sense.
Well, Nitin, you know, I've never considered you as a radical person, but I think that's because you aren't. You're well measured. You're absolutely right. But your statement of number one is actually quite radical. The concept of actually pulling the stable coins away and not having them as a major part of the industry is radical, because it's the only comfort zone that traditional industry has when it starts entering this industry, is that it's able to measure it in a measurable way that it's used to, and that is fiat currencies represented as a digital asset. So I can see the logic of what you're saying there, because the contagion to traditional industries is spread rapidly through stable coins. The interesting thing is that traditional industry wants to access this space through stable coins. So that's quite a radical move. But you know, well considered, because you're right, the contagions are very substantial. The statement that there's a lot of data but there's no insights is very true. You know, in traditional industries, when you've got the feeds of Morningstar and Bloomberg and so many other microsystems, so many other major feeds of data that are available to everyone's fingertips. In this industry, you've got to be pretty savvy to be able to access the right data and have it in a meaningful way. I mean, by example, you know, we employ a data scientist, Petros, who is really an exceptional and outstanding. Yeah. He has to analyze this data constantly because so much of it's not readily available in some other mechanism, probably just because of the youth of the space. But the fourth part you raised, I think, is something that you can immediately relate to. And that is, you know, why would you bring on, again, you know, the 1934 SEC guidelines to transactions of equities and try and overlay that into this space? Why not create, you know, the major community writers, the code writers that are community driven to create that space? Because, you know, the law is the code in this area. And if you've actually got them writing the laws and building code in place that can enable the laws, you really are starting to create a judicial system which is totally different to traditional judicial system, but could work. You know, I cite for a moment, you remember the Polychain attack, $320 odd million. It was a fascinating attack because, you know, the minute the person that attacked that, was it 600 million, was it? Oh, I hate to be half done there. 600 million. And one person did the attack. And immediately they knew the wallet address. And so immediately they tracked him. The community knew within 90 seconds, not 3 months. A lot of white collar crime takes 3 months. It was 90 seconds. And then what happened, of course, Nitin, is the community started gathering around and shutting down the opportunities he had or she had to transact that money. So in some ways, we saw the community engaged in resolving a problem. And I understand that all, if not the vast majority of it, was returned within 10 days in resolving a crime. So we actually saw the early stages of this unstructured way of community actually acting, didn't we?
Correct. Correct, but there's a difference though, Derek. I think there's one is financial crimes, and I draw the data buckets into two different buckets. One is financial crimes, all the things that you mentioned, where the money go, who stole it, which wallet it is in, and if that's the wallet, can we track the movement of money from that wallet out, whether they're mixing and tumbling and go to other wallets? Can we blacklist all these different areas and so on and so forth?
Yes.
Of course, there was a question, moral question: can they do that for stablecoin? Yes, stablecoins were prevented from being redeemed because they were issued by a centralized entity. That to me is a governance mechanism. That to me is a shock absorbing mechanism for financial crimes. But the thing is that how did the community not know, like in case of Celsius, which is something which I've always debated. Same thing with Terra, that if you're offering 20% yield, no such thing as the risk-free yield. You're risking something. And I think it's important for them to disclose that risk, to say, we're paying you 20%, but these are the risks that go with it. And if that risk is embedded into some long terms and conditions that people simply accept without reading, then that's unfair to the investors. The same thing with Celsius. If they were offering 12%, they acted like a bank in saying you can deposit your money with us and we will. But they were making investment in very risky assets, as we know now. The question that becomes is, do we have enough data to expose that? And of course, people did know that. I mean, some of the industry leaders did look into that and say, hey, we are staying away from this because they are going after some very risky assets that may be highly leveraged, whether it's staked ETH or whether it's going after some yield farming product that may have a ripple effect from the industry. I think these are risk factors that are not neither explicitly discussed, nor that information is readily available in data. Data is there, but someone has to join the data and make sense of it. This is what I meant by insights. So I do delineate between financial crimes and market data as two sort of angles that they should look at. Financial crimes is post event, but many of the stuff should be disclosed to say, where is this token going? And if the industry prides itself at transparency, I think it has to make that information available.
So how can you get institutional validation? So by example, when we bank here in Australia, we bank with one of the big 4 or 5 banks. So you know them all, NAB and ANZ and Commonwealth Bank.
I've worked with all of them, yeah.
And so we know that those banks are government guaranteed to a certain level per account, about $200,000 by memory. We know that they operate and are audited within certain sections. We know they're listed on the Australian Securities Exchange, so they provide constant disclosure to the marketplace. And we know they operate on a certain ratio of cash to loan assets, et cetera. They're all defined, and they're defined by the ASIC, the Australian Securities Investment Commission.
That's right.
And so therefore, these institutions have defined these banks as the creatures that they are, so that when you know you're going to put your money in them, you actually know that this is the group that this is the parameters and the credibility of the group you're doing business with. That doesn't happen in crypto. And
it doesn't,
yeah, that's part of the challenge of not being able to have some institutionally endorsed product. But what your suggestion in your point 4 is that these guidelines get created by a community, they get published, they get achieved by the organization that's putting themselves forward as the particular service, and that the community validates these and measures them.
Correct. And for instance, all the transactions happen in layer 1 at the end of the day. So whether it's layer 1, layer 2, whether it be, and we discussed the various layers, whether it's a project that's happening with an exchange, a decentralized exchange, any project that launches at the end of the day uses some layer 1, whether it's Ethereum or whether it's Solana or Cardano, Avalanche. Yes. And I think that community is very strong. And I think that as a prerequisite, if the community were to suggest that every proposal, every investment that the community or that project makes, and some of the projects can be centralized and should be centralized, because that's the whole point of future of work, that if I'm talented, I should be able to come up with a project and which has amazing mechanics, amazing economics, and propose that to the community. The community should be able to vote on it. And I think that layer 1 entities should be able to say, thou shalt meet these 15 requirements, and the community can then talk about the risk and everything else and vote on the project, which I think is a fairly decent governance mechanism, which I don't think is followed today. I think people launch a project, people have this sort of, the notion that it's, the godlike worship that happens to some of these founders. And I think we should be a bit more pragmatic in understanding the fundamentals of economics of who is paying and who is earning, and what is the value being created, as opposed to, just a notional value of how things grow, I think.
So this is really interesting because we've often discussed the concept of layer one protocols being sovereign states.
Yeah.
And what you're suggesting is they operate like sovereign states to a degree, like sovereign states. So when they onboard a product, they have a responsibility to determine whether the algorithms are reasonable, robust, and could survive. Otherwise, that there should be an adequate disclaimer, by example.
Correct. I mean, as any country who would like to be in, again, the good books of the national bodies who govern the banking and have the regulation, they don't want nefarious activities in the country. In fact, most countries don't want that. And so they define their own governance mechanism. They define anti-money laundering mechanisms to make sure that there's a system that's in place that prevents these nefarious activities. I think just similar to that, the layer one, if they choose to have the nation state status, they should have something similar as a sort of a SRO to say every project that's governed this has to go through this mechanism, which will also protect that layer one, but also have the reputation of layer one, that it's safer to do business on that layer. Yes. And I think that's exactly the way, right? That you're very powerful, codifying these governance mechanisms, I think.
Yeah, that's really powerful, Nitin. I'm not quite sure how you do it without stable coins. Maybe that's just my connection, the fact that I'm still grounded on the concept of stable coins and the onboarding function of those. But that very compelling to think that these major sovereign nations, these major blockchains, then can become validated, not just on maybe the efficiencies of how they do business or the cost per transaction, but the strength of the community that's running them. And I mean, you look around the world, that's what happens with sovereign nations. There are certain African countries that you look at and say, it's got too much sovereign risk, I won't do business there. But on the other hand, you look at Singapore and you go, exceptional country, very, very low sovereign risk, good place to do business. If you can get the same sort of thing happening with a set of regulations relating to each one of these layer one protocols, then people will aspire to reflect their product on certain layer one protocols. Really powerful, and some good ideas there.
No, absolutely. I think we have a lot to do. And I think, again, I'm publishing this hopefully next weekend in terms of my thinking. And again, I think there's something which, as an industry, we should address, whether we are, no matter what capacity we're working in, whether you're looking at from periphery or you're actually a developer building an ecosystem, building protocols and code is, if that's what's governing this, then I think each one of us has a responsibility towards it.
So as we get to the end of the program where we are, we really have to realize that this is constant. This is like putty in our hands. The community is able to build this in ways that are totally novel and unique. And the reason why, of course, at the end of the day, is because it's a replacement of the double entry bookkeeping system in the form of a providence validation layer one protocol. And what gets built on top of that becomes our imagination. Human nature is getting involved with it again, which is the creation of communities and the creation of reasonable guidelines and safety protocols that you'd expect that humans will want to operate within. But it is going to disrupt. And during that disruption period, I think we're going to see many protocols fail along the way or applications fail along the way. There's nothing wrong with that. And you're going to see interfaces with traditional finance also be stretched, let's say. And there's going to be doubters and believers, et cetera, et cetera. That's what happens when a very radical new asset class suddenly appears in what is really 10 years flat, which is what happened with us. So I don't think we're going to run out of content, Nitin, for the next few hundred episodes. There's much to come.
That's true. And I think, again, we have to just be at it and educate and be a part of that whole journey. And so, no, I appreciate the conversation, Derek. I think we need to have more of this to be able to guide and educate our listeners as well as the industry and play our part in fixing it. And I'm not so worried about failures because let's face it, I think the existing financial system has own failures and, massive failures in the past. And I think the system that is today is a product of learnings from that failure. So I think we should learn from it and make it better. That's it.
Yep, I totally agree. And by the way, for those that are listening to us, always feel free to write in, suggest comments, suggest you might like to be on the one of our events or one of our shows. We'd be delighted to hear from you, and our contact details are always connected to the podcast at the beginning. Look forward to seeing you next week, Nitin. Have a good one.
You too. Bye, Derek. Good chatting.
See you. We hope you enjoyed our weekly conversation. If you have any questions, comments, or suggested topics, please feel free to connect with either Nitin or myself on nitin@portal.am or derek@portal.am. Feel free to subscribe and share with like-minded friends. Stay well, inquisitive, and engaged. See you next week. Bye for now.